Without further ado, I will hand over to James Hart, who's the Investment Director at Witan.
Good afternoon, everybody. I hope you can see me and I hope you can hear me. What I'm going to do is share my slides so that you can follow the presentation. So just bear with me 1 second while I do that, and we can be off and running. Thank you. It's a huge pleasure to be talking to you all this afternoon. As Paul said, Witan is one of the oldest and one of the largest, he said most respected, I hope that's true, of the investment trusts listed on the London Stock Exchange. You know, our belief is that we provide a valuable service to a large number of investors, giving them the opportunity to invest with some of the best managers in the world, and to have a diverse portfolio of equities. So what I'm going to do to start with, and obviously with these sorts of events, there is a mixed degree of knowledge of Witan. So I'm going to start at the beginning with a fairly basic introduction to what we do and how we think about life, and then obviously if there are more detailed questions, we can pick those up in the Q&A. So, what is Witan, and how do we manage assets? Witan is it's a global equity fund, so we can invest across the world in equity markets. We adopt a multi-manager approach. That means that the individuals that are employed by Witan are not responsible for picking the individual investments within the portfolio. We outsource the stock selection to a group of managers. Typically, there will be between 8 and 10 managers who will be selecting stocks on our behalf, and they will each have a different investment remit. It's an actively managed investment policy. That means that our manager portfolios, and indeed the combination of those portfolios, will look very different from the benchmark that we're aiming to beat. So it's not an index product. It's a fund of some of the best ideas of the managers that we appoint. We have total assets of just over 2 billion sterling, and as I said, we are self-managed. That means that there is no investment management company that is separate from Witan Investment Trust. There are employees of Witan Investment Trust, of which I am one. Our sole job is to manage the success of Witan on behalf of our shareholders. So we are answerable only to our shareholders, not to an external asset management company. So we believe that that helps to align our interests with our shareholders. And I was a bit disappointed actually that I couldn't vote in that initial question, are you a shareholder or not? Because I certainly am, as are all of my colleagues. Because we are employed by Witan and there is no management company, there's no additional layer of fees to pay. So quite often when you have a fund of funds structure, you'll have a fund that is charging a fee for their, or a fund manager that's charging a fee for their expertise, and then obviously they will have fees to pay to external managers. But because we are employed by Witan, there are no fees, no additional layer of fees to be paid. Of course, there are costs to running Witan, but no ad valorem fee. Being an investment trust, we believe, gives us many advantages. One of which, of course, is that we have a non-executive independent board of directors. There are currently 8 directors, 8 of whom are non-exec, and one of whom is the Chief Executive Officer of Witan Investment Trust. It is the board that defines the strategy, and it then asks us as the executive to implement that strategy. And part of that is the identification, selection and monitoring of the external managers that we appoint. We do this in association with the board, and in fact the board is the one that has the final say on which managers are appointed and which are not. And those managers are required to report to the board on a regular basis, and they report to us as the executive on an even more regular basis than that. We have a number of tools as an investment trust that we can use to help to boost, hopefully, returns over time. We can use gearing, modest amounts of gearing, I might add. Typically, the portfolio is geared to the tune of about 10%. It can vary and often does vary depending on our view of the market. And we can also use other tools under the delegation of power set by the board, including simple index futures and ETFs to help us to increase or decrease exposure, or to tilt exposure to and from various asset classes as and when we feel that those are the right opportunities to be taking advantage of. Crucially, unlike a fund of funds, the multi-manager approach relies on all of the managers managing money in accounts that is in our custody. So it gives us, we have much better oversight of our portfolio because we can see all of the assets that are held in our custody. We can see all the trades that the managers are doing day by day, week by week, month by month. And it helps us to question those managers when things are going well, or indeed when things aren't going so well. It gives us information on how they're thinking about life, how they're trading their portfolios. Some trade more regularly than others. And also it gives us a really good level of detail when we're thinking about how we interact with our portfolio managers and how they interact with their portfolio companies when thinking about environmental, social and governance issues. And we'll come on to that a little bit later on. So how do we implement the strategy? The way we think about it is that we have a global equity portfolio. It is one portfolio, but we think about it in two lumps of equity, if you like. The first is a core portfolio, and within that core portfolio are our global and UK equity managers. Obviously, there are parts of the world equity market that are better addressed by specialist managers. And so we appoint people to look at more specialist parts of the market where we feel there are greater long-term growth prospects. And here we might be talking about, for example, a relatively new strategy that we invested in 2 or 3 years ago, which was a climate change portfolio. Emerging markets fits into this category as well. And we also have what we call a direct holdings portfolio. Now, it's a bit of a misnomer because it's not a direct investment into listed companies. It's actually a direct investment into collective funds. But those collective funds are specialists. And it might be private equity, life sciences, obviously life sciences, biotechnology, a very specialist part of the investment landscape, and it's much better approached by people who are specialists in their field. Within the core portfolio, we have a range of different managers covering different parts of the investment world. But this isn't a smorgasbord of different managers. When you put them together, you just end up with what is effectively a global equity index. They all look at the world in a different way, but at the heart of their investment process is buying good quality companies that are going to be able to have enduring cash flows over the long term. Some of our managers are more adaptable, and at times they will buy high growth companies, and at other times they might buy into companies which are more cyclical in nature, or deeper or undervalued. And so when we put them together, you end up with a broad portfolio of global equities, but one which isn't a replication of the index. So what do we look for? Primarily, we look for people who are going to add value for Witan's shareholders, and listed there on the left-hand side are the key attributes that we look for in managers that we appoint to run money on behalf of Witan. Typically, you'll find these people in an investment boutique rather than in a large multinational asset management company. The reason that we tend to be attracted to these sorts of managers is because we find them more accountable, and they are more aligned to their clients' interests. So, for example, they don't have a board that is wanting them to grow assets under management that might obviously be at the cost of good performance. We look for people that run high conviction portfolios, perhaps with a concentrated stock list. Typically, our managers will run portfolios of between 20 and 50, perhaps 60 stocks within the portfolio. So very concentrated portfolios, so that when we blend these managers together, we end up with a portfolio of somewhere between 250 and 300 stocks in Witan's overall portfolio. It means that each of our managers is able to contribute to returns. They each have the ability to produce quite significant outperformance or indeed underperformance if things are not going their way. But what it does mean is you have a collection of ingredients in a portfolio that is able to earn its place within investor portfolios. As I said earlier, typically the investments within manager portfolios will be companies that are characterized by these long-term growth in sustainable cash flows. And we want our managers to own companies that are going to be there for the long term. So they need to take account of the changing investment and indeed social environment, so that they take into account of all the factors that are changing around them. So this might be the threat from technological innovation and disruption, or indeed it could be the threat or opportunity that is posed by climate change. You might wonder why I'm saying opportunities posed by climate change. Well, there are a large number of companies within the investment landscape that are set to benefit, we believe, quite significantly over the next 5, 10, 20 years as the world tries to adapt to a warmer world. So there are many companies whose technologies and whose products are there or will be used to mitigate or adapt, help us mitigate or adapt to climate change. But above all, we look for managers who are capable of producing material outperformance over the long term after their costs. And costs, it's an important point to mention because costs do detract from performance, of course. But our belief is that we should get the best managers available and then negotiate as hard as we can on the fees that we pay them, rather than necessarily trying to find the cheapest managers in the world. That brings us on to talking about our role at Witan. So we've identified the managers we want, and we put them together, blended them together to make a portfolio, and then it's down to the board and to us to allocate capital or vary the allocation of capital, either between the managers or increasing or decreasing gearing, or indeed flexing the asset allocation when opportunities arise. There have been a couple of examples of this in recent years. For example, very few of our managers owned any shares that were listed in Japan, but when Shinzo Abe was elected in the first half of the last decade, it was very clear that this was going to be a positive outcome for the Japanese equity market. So we were able to use Japanese index futures and funds to increase our exposure to the Japanese market, to be able to supplement any exposure that we had through the manager portfolios. And as you can see here, the long-term outcome of this strategy is that we have a progressive dividend policy. It's one thing that I omitted to say at the start, actually, is that our objective is to produce a total return which exceeds that of our benchmark, and to grow the dividend ahead of inflation over time. We have increased the dividend, and this is one of the beauties of the investment trust structure. We have increased the dividend every year for the last 46 years. And despite the fact we had quite a shortfall last year in the face of the pandemic, we were able to increase the dividend again last year, and the board is committed to maintaining that dividend growth over the long term. I briefly mentioned responsible investment, and I use the term responsible investment rather than ESG because I believe that because that's exactly what it is. It is And ESG is a subset of what you might call responsible investment, because when an investment manager analyzes a company, of course, he analyzes all sorts of things. He analyzes the economic environment in which that company sits. He analyzes the specific financials of that company. He analyzes the culture of the company. But he also analyzes the governance, the G in ESG, to ensure that it's being run properly, and takes into account the way in which that company operates, both in an environmental and a social aspect. For example, if you were to buy shares in Nike, and you hadn't done your work and found out that Nike, now I'm not suggesting that Nike is at fault here, it's just an example. If Nike had been using a supplier who had in turn been using a substandard factory in Bangladesh or in China, where the working practices were not up to scratch, then it would be Nike's reputation which would be at risk. And so it's very important that our managers do that level of due diligence to understand the full value chain of the company in which they're investing. Same goes for environmental standards as well. We were invested last year in a company called Norilsk Nickel, which is clearly a nickel producer based in Russia, but they had a fuel spill which polluted part of the Arctic region. So there are real environmental and indeed financial risks to not understanding how your companies are operating. In that example, we use a company called Repurchasing, which is a company which identifies potential reputational damage to a company and alerts us to it. So we were able to go and talk to the manager concerned and say, what are you doing about Norilsk Nickel? Have you spoken to them? You know, what assurances have you had from that company that they are going to address those issues? And so that's how, in a nutshell, briefly, how we think about responsible investment. I know it's something that has risen in prominence over the last couple of years, but it's something really that's been at the heart of good investing for many years. And I also mentioned that we believe that there are opportunities afforded to us from climate change, and we have made investments in sustainable energy strategies and indeed in the climate change strategy to enable us to make money on behalf of our shareholders from technologies and companies which address these issues. So this is a list of the managers that manage money for us. Some of those names I'm sure you all know, they're household names. For example, Lindsay Train, who runs a global equity mandate for us. They own a group of companies where they are highly respected brands or companies with enduring cash flows. Veritas is a manager based in the UK. They tend to buy good quality companies, but have a very keen eye on valuation, so they won't overpay for potential growth. Jennison is a US-based manager that invests in very high growth businesses, which are typically highly valued and can be quite volatile in stock market terms, so they have a lower allocation. WCM is also a US-based manager based on the West Coast. Again, they buy good quality growth businesses. Artemis is a manager that focuses on the UK, and they buy special situations. So these are, again, good quality companies that have gone through a period of underperformance. It might be that there's a management change that's gone on at the company in question, or that they've lost their way for one reason or another, and Artemis will buy into those sorts of opportunities, expecting new management to come in and improve the prospects for companies like that. But Lansdowne is our largest allocation. Lansdowne is a boutique based in London. They're a very adaptable manager. Their portfolios have, over the past, contained companies such as Alphabet, Amazon, and a lot of the other large technology companies. At the moment, they see more opportunity in some cyclical businesses, banks, materials companies, for example, or indeed paper and packaging manufacturers, addressing this need to cut plastic in society and to increase the recycled element of packaging. And within the specialist manager lineup, we have a climate change portfolio run by a firm called GMO, This is a climate change portfolio with a difference, because quite a lot of the technologies that focus on high growth areas such as solar power, wind power, are very highly rated. And so the manager thinks very hard about the valuation of the companies in which they're invested, and continues to rotate the portfolio away from those companies that are very much in high demand and therefore very highly rated, and into companies that that offer better value. I'm going to come on to talk about the portfolio characteristics briefly. So when we put all the managers together, this is what we end up with. We end up with a portfolio that is broadly spread across the world in terms of geography. The US is the largest market at about 40%. That's lower than the benchmark weight of 50%, but it's still the largest market. The geographic weighting of the portfolio, it must be stressed, is very much driven by our managers' selection of stocks and where those stocks are domiciled, not by a top-down asset allocation dictated by us. And we're very happy with that, because we believe that the world is or contains a multitude of great investment opportunities, and it's less relevant where those companies are based and more relevant what those companies do. And so the next biggest position is in the UK market, primarily because a lot of our global managers, and those of you that invest in the UK market will probably be reassured by this, not that this is a recommendation, of course, but that those managers who are able to invest across the globe are finding more and more opportunities in the UK market at the moment. And perhaps that's reflected in the increased level of M&A we're seeing in the UK market, but that's by the by. That's where they're finding the opportunities. And Europe is obviously the other big area. In terms of allocation by sector, is pretty flat, really. The biggest allocation is to the information technology sector, unsurprisingly, slightly below benchmark, but still the largest allocation. Industrials has historically been quite a big area for Witan to be invested, remains quite a big area. These are good quality cyclical or non-cyclical industrial companies, communication services, consumer cyclicals. Where we're underweight is financials. Primarily, that's due to an underweight in insurance companies rather than banks, although we are slightly underweight banks, but primarily underweight insurance companies. And we're overweight materials. And I think that's interesting because, partly this is a reflection of the much better discipline that management has had within the mining companies, making them more attractive investments. And that coincides with a significant increase in demand, and indeed in potential future demand for mined metals, particularly those that are going to feed into the build out of a greener energy system. We're also finding positions in here in building materials as governments look to build their way out of a pandemic, and indeed individuals doing likewise. Where we're underweight is energy, have been underweight fossil fuels for a long time. Clearly, there are points in a cycle where oil companies do perform well, as in the last few weeks. But typically, our managers find them to be less attractive long-term investments. So I think it's important with the time that we've got left to talk about the direct holdings portfolio, which we believe is something that is quite different that Witan offers our shareholders. So I talked at length about what our managers do. Whoever you appoint to run money for you, there will always be parts of the market that they don't address. It might be that it's outside their investment remit, or it might be that those parts of the market are more specialist and therefore requiring a more focused skill set. So the direct holdings portfolio, as I said at the beginning, invests in collective investment vehicles, typically investment companies, to gain access to those parts of the market that our managers don't give us directly. So the two biggest holdings, and by these percentages, are percentages of the direct holdings portfolio, not of Witan's overall portfolio. So the largest holding is in Apax Global Alpha. That's a listed private equity investment company run by Apax Partners. Princess Private Equity is run by another very well-known and well-established private equity group called Partners Group, based in Switzerland. We then have an investment in Electra Private Equity, which is one of the oldest UK private equity vehicles, but unfortunately, it has had to go into a wind down over the last few years, primarily because it was a victim of the financial crisis and a deep discount that its shares traded on post the financial crisis, which allowed shareholders to come in and force a liquidation of the company. We've invested in it because we believe that the underlying value of the assets are greater than its current share price. And so Electra Private Equity now contains just two holdings. One is TGI Fridays, the casual dining chain, and another is Hotter Shoes, which is a UK shoe company. Hotter was fortunate in that it had a significant high street presence up until last year, but during the pandemic, it was able to remove itself from the high street and cut significant costs out of its business, which now means that it's a much more valuable business than it was a year ago. And TGI Fridays is about to be renamed Hostmore and listed on the London Stock Exchange, and we believe that the sum of the parts is significantly more highly valued than the price at which Electra is trading. BlackRock World Mining, the clue's in the name. It's our way of getting increasing exposure to that theme I was talking about earlier, which is exposure to world metal production, particularly as supply is constrained at a time where demand is likely to increase. Syncona and BB Biotech are both life sciences businesses, which give us exposure to a very long-lasting growth theme, and the Sustainable Energy Fund here, which is building out solar plants in Brazil, battery storage technologies in Australia, and sustainable fuel businesses on the US-Mexican border. So that brings us to the top 20 holdings as they stand. Some of those direct holdings names you can see here starred with an asterisk. So Apax Global Alpha and the Climate Change Fund are the largest holdings. And then there will be a number of holdings within this list that you will recognize. Alphabet, Unilever, Diageo, Intuit is an enterprise payroll software business in the US that's similar to Sage, but more dominant and perhaps a better business. PayPal, and then some further names down here like Heineken, Amazon, of course, Mittal Steel, and NatWest and BT, and Charter Communications, of course. Charter is, I suppose, the US equivalent of a combination of BT and Sky. So it's cable TV, broadband voice, and TV. So those are the top 20 holdings, which end up being the result of our manager stock selection. Just briefly touch on the more corporate information about Witan Investment Trust, because of course an investment trust is a company, it's not a fund. I mentioned that we have a progressive dividend policy. The dividend has grown at an annualized rate of nearly 10% per annum over the last decade. Obviously, the pandemic had a big impact on revenues earned within portfolios across the investment world. And our income suffered likewise last year. But as I mentioned, the ability to use revenue reserves to smooth our dividend meant that we were able to increase the dividend last year, even in the face of the pandemic. And the board has committed to use revenue reserves to continue to increase the dividend over the long term. I also briefly mentioned gearing earlier on. One of the key benefits of an investment trust company. As you can see, in most of the years over the last decade, it has been a contributor to returns. Clearly, when the market is weak, it is a detractor, but over the long term, we believe in the benefits of employing modest amounts of gearing. Our gearing tends to fluctuate between 5 and 15%. Typically, it's around 10%. And it is a mixture of fixed rate and floating rate debt. And we believe this is a significant benefit to the investment trust structure. So we've got fixed rate borrowings ranging between 2.39% and 3.47%, fixed for between 2035 and 2054. So very long-term debt, low interest rates. The aggregate rate of interest is 3%. And with all the talk of inflation and rising bond yields at the moment, we believe that's a very valuable debt structure to have in place, because we'd like to think that over the next 10, 20, 30 years, we'll be able to make returns in excess of 3% for our shareholders. We also have short-term borrowings, which are more flexible in nature and indeed cheaper, as you would expect with a mortgage, for example, where you pay more to have a fixed rate. The short-term borrowings here are at a cheaper rate, but they have the benefit of being flexible to draw down and deploy at will. As you can see, the pink line here, which is the cost of our debt, has declined over the last decade, and that's because we've been able to refinance all these fixed rate notes at significantly lower interest rates than we were able to, than we had to pay in previous decades. And that leads us on to a couple of closing slides. One showing a 10-year performance history. As you can see, the blue line is our share price, the green line is our NAV, and the pink line is our benchmark. So long-term outperformance of the benchmark. We did have a bit of a tricky time at the beginning of last year when the pandemic hit, because we were set up for global economic expansion at exactly the time that the world closed in. But I'm really pleased to see that significant recovery from that period and a return to the old pathway. Obviously, past performance should not be taken as an indication of potential future returns. And finally, investment trusts do and can trade on, do trade on a discount or premium to their net asset value. Over the last 10 years, we've seen our discount narrow from about 10 to 12% to trading at par, and indeed even at a premium for a couple of years, where we were able to issue new shares at a premium to asset value. We can only issue shares at a premium to asset value. Then we had Brexit and a large institutional seller that pushed the discount out a bit, and then it returned back to close to NAV, which is where the board has said that it would like the shares to trade at a sustainable low discount or premium to asset value. And therefore, when we see a discount widening like this, we will buy our shares back. And we have, as a sign of how cheap we think the shares are, we have bought nearly 6% of the shares in issue this year at a discount to asset value. The discount is currently at about 7.5%. And we would like over time, although obviously there's absolutely no guarantees of this, we would like to see the discount return closer to NAV. And I think on that note, I will leave it there. I'll leave the outlook up here on the screen, and we can talk about the economic outlook if people would like to ask questions on that. Otherwise, I'm very happy to answer questions on any of the things I've talked about today, or indeed things I haven't talked about today.
Great, thank you very much, James. Very interesting presentation. We've got a couple of questions, but do add more, folks. I've just got, I guess, one question when you asked about the economic climate. To what degree are you able to position yourself if you feel the market's overvalued? You know, what's the most you would ever hold in cash? Are any of the people that you invest through capable of taking short positions? Those kind of questions.
Well, I'll deal with the second point first, if I may. We set our managers a very simple set of investment boundaries. They can own equities, but they can't hedge. So they cannot short. They can't use any other kind of derivatives. They can't, they can't short individual companies. They can't have puts or futures on indices or anything else. They can hold cash, and some of them are limited to the amount of cash they can hold. Some of them typically will have no cash at all, because they're long-term believers in owning companies, good quality companies, and to a certain extent, not worrying too much about the absolute level of the stock market. If you own a good quality company, and Lindsell Train is a good example of this. They very rarely will sell an investment. They'll own it, being happy to endure periods of volatility in the share price. Other managers will typically have some 5% in cash, maybe, or up to 10% in cash. In terms of our own, and obviously we see all that because it's a multi-manager structure, not a fund of funds. We can see exactly what cash is in what portfolios at any time, and that can feed into our own decision making about the level of gearing that we might want to be employing at the Witan level. Managers themselves can't gear; they can't employ gearing within their portfolios, and so. And our general rule of thumb is we want to be fully geared when we believe equities are cheap, and we want to have very little gearing when we believe equities are expensive, and that's largely driven by the valuation of equities rather than necessarily short-term drivers of what, if you try to position yourself for every one of the nearly 70 setbacks in the stock market that the current bull market has enjoyed. I'm talking about the US market here, because obviously the UK market has dramatically underperformed the US market. But if you always try to position yourself for those short-term setbacks, you'd miss most of the upside. And so what we try and do is vary our level of gearing dependent on valuations rather than on, what we might see as short-term risks.
No, that's very, very, very helpful. And yes, just I guess using gearing as a slight touch on the accelerator or on the brake.
Absolutely. And we don't tend to go into cash at the Witan level. We understand that for our shareholders, Witan Investment Trust is quite often a large part of their equity allocation. So their allocation to equity markets. And so if we were to suddenly say, that we want to have 20% in cash, we're making an investment decision on behalf of our shareholders that I don't think that we're mandated to make. We have cut gearing, by the way, to zero. We did that in the financial crisis because obviously it was very difficult to know if your pound was going to be in the bank, let alone what your pound was worth at that point. And indeed, we cut gearing quite significantly last year in the face of the pandemic.
Okay, now one of the benefits that I get from hosting this is I get to ask my questions. So I will get around to other people's, but I saw your largest holding is the GMO's Climate Change Fund. I'm right in thinking that's Jeremy Grantham's involved in that, isn't he? He's the G in GMO.
He is the G of GMO, you're absolutely right.
Yes, and I would recommend anyone that's watching this, I would recommend you listen to his podcast whenever he gets interviewed by anyone, because he's the most beautiful public speaker and an incredibly intelligent guy, but rather a perma bear. He's always talking though about the benefits of venture capital, and is that what he's largely investing in with that fund there? Is it smaller startup disruptive type companies?
No, and just to clarify, we were delighted actually to welcome Jeremy to one of our board meetings 3 years ago it was now, after he wrote a very provocative piece called "The Race of Our Lives," which was all about how we need to take into account the threats and risks of climate change, and how we need to think about adopting that thought process into investment management, because it is a financial risk. But Jeremy doesn't personally manage this fund. He's a very long-standing investor and a great talisman for GMO. But the fund is actually run by the global equity team. It's all invested in listed equities, so it's not venture cap, although it does have a number of smaller companies within its portfolio. And just to be clear, there are a lot of companies in the world that promise the earth, that are quite new, where the technologies are unproven, and you're investing, or perhaps even not investing, you're gambling on the prospect that whatever technology they're coming up with might win or might not. That's not the way that GMO invest. They invest in established businesses that they might be smaller companies, but they're established businesses with positive cash flows. As I say, that they're addressing the provision of solar power, wind power, fertilizers to meet the threats that climate change are posing on agriculture. They own mining companies, which some people might think, what on earth is a climate change portfolio owning a mining company for? Because they're not the cleanest companies in the world. But they're very vocal on the world's need to build out an infrastructure to combat climate change. Needs steel, and it needs copper, and it needs all these things that we're going to have to build over the next 10 years. So, to exclude companies like that from a portfolio would be not necessarily the best economic outcome for shareholders, and it certainly wouldn't get us to where we need to get to in 10 or 20 years' time without those sort of commodities at our disposal to help build out these solutions.
Yeah, no, I get that. Change won't happen by itself, and you need these enablers. So to go on to the questions from our audience, you have sort of half covered some of them, but I think it's probably good to go a bit directly. Our first one is about, you've been very aggressive historically in buying back shares when you've been at a discount. And I think you've already reduced the number of shares in issue by over a half. So
that's correct.
The question is, how much further will you go? You get down to just one or two shares in issue.
Yeah, I mean, look, that's a very good question. I think we are lucky in that we have an investment company with assets of over £2 billion. I mean, and one of the issues when you're buying back shares is if you buy back too many shares, you shrink a company to such an extent that the costs of running it overwhelm the returns that you might be able to make, or that the liquidity in your shares dries up to such an extent that nobody will want to buy you. So actually, you end up buying back lots of shares, but you don't deal with the discount issue. No, our feeling is that a discount is where the market sets the price for shares, and we as a board and as managers can help influence the market's view on the level of the discount, because if we're prepared to buy shares back, that should send a signal to the market that we believe that the shares are cheaply rated. And of course, it's good news for shareholders that are remaining, because buying shares at a discount is accretive to the net asset value. You buy back shares when the rating is too cheap, and sooner or later the rating will look after itself, as we saw for very long periods from 2014 through to 2019, where we didn't have to buy back many shares at all because the rating was very close to asset value. But we can only be participants in the market rather than guiding the market totally. And so no, we'll continue to buy shares back. We're not worried about the size of the company.
No, and I guess as well, it depends on often just on trends, doesn't it? That sometimes there's a bit more of a trend for retail investors, who I think has always been a significant part of your shareholding, to perhaps buy trackers, and other times they're looking at more active management, and so just as things swing in and out of fashion.
That's very true. I mean, 85% of our shareholders are individuals, either directly or through platforms like Hargreaves or Interactive Investor or AJ Bell or whoever it might be, or indeed through private client stockbrokers or wealth managers. And, you know, sometimes they have calls on their capital, but, you know, there's a lot of new issues at the moment. And you can imagine that they've got to find the money from somewhere. So
and one of the other questions here is related, when you repurchase shares, you cancel them, don't you, rather than hold them in treasury, or do you hold them for people that have their sort of regular reinvestment schemes? I don't know if you still run that.
We don't run our own savings scheme anymore. That was transferred to Hargreaves Lansdown a couple of years ago because we felt that, you know, the cost involved of maintaining that scheme to a standard that people should expect these days was just too high. And, you know, there were lots of other opportunities for them to use online platforms, whereas when the scheme was set up, there weren't those sort of opportunities available to them. No, when we buy back shares, we do hold them in treasury. So they can be reissued, but they can only be reissued at a premium to asset value.
Right. And so they're not eligible for dividends during that period?
They're not eligible for dividends, no, and then they're not actually counted when the net asset value is calculated either. So when they're bought back, they have the same monetary effect as if they were cancelled.
Right, good. Okay, so this one is quite an interesting one. You mentioned the opportunity that Japan posed a few years ago. And the question we've got is, how do you view the current situation in the Chinese markets, particularly the ongoing regulatory actions? And I guess I just add my part to that, which is, you know, to what degree do you rely on external managers to make these decisions, and to what degree do you sort of impose a Witan view?
Yeah. Well, I'm very glad we don't have a manager that has to own equities in any one country. Apart from, we do have one, of course, which is our UK manager. But apart from them, you know, one of the ways that we think about structuring Witan's manager lineup is that all of our managers, barring the UK one, are able to invest in equities across borders. And so when you have a situation like the one that we had recently in China, or are having in China, you are able to take evasive action if you want to. And I'd love to be able to claim perfect foresight here, but we had an Asian manager who was responsible for investing on our behalf across Asia, and of course he had a significant weighting in China. But we decided to close down that mandate in April of this year, before all this news broke about the regulatory clampdown in China. Not because of that, but we closed it down because we felt that our investments in China, and this comes to your question, our investments in China were the result of stock selection by our emerging market manager, and of course by our global managers as well. So if they found companies in China, or indeed anywhere else in the emerging world, that they felt they wanted to own, they could own them. But if they felt that the risks were too high or the valuations were too high, they could own companies elsewhere. So we were fortunate, actually, that our emerging market manager had been reducing exposure to China because of the increased risk that he perceived there, particularly coming from the fact that some of these companies were quite highly rated, but also because you know, increased interference from government at the same time as some of our global managers were also didn't have much in China. So we only got about 2 or 3% of assets in China as we speak. You know, what do we think about the situation? Well, the Chinese government often, you know, rattles a saber from time to time just to keep everybody in check. I think this is a more severe bit of saber rattling than they've been used to in the past. And, you know, it is a concern when, you know, they pretty much destroy a whole industry with the swipe of a pen. So I'm talking here about the education, the whole education sector in China, where they deemed that companies that were made a profit out of education should not be operating for profit anymore. Well, you know, that wiped out a lot of people's investments in those sectors. So Investing in China will always carry that kind of risk, but there's tremendous opportunity as well. And so we like the fact that we outsource the selection of companies, be it in China or anywhere else in the world, to people who are well used to weighing up the pros and cons of the potential growth versus the risks involved.
Yeah. And that's a relatively, again, I could be wrong here, but it's a relatively recent change, isn't it, from you to not have regional country-specific managers? That I seem to have, was it Matthews that was running a specific Asian portfolio? And Veritas, when I see their name up there, I own a Veritas fund. I think of them as Asian specialists, but obviously they have a global approach too. That they're capable.
They do actually have an emerging market. Yeah, they do have an Asian strategy, which we're not invested in, but we're invested in their global strategy.
Right.
Now, they are quite strong in Asia, you're right.
I've left one of the hardest question to last, which is from Roger Lawson, who's very good at asking difficult questions. And he says, you've obviously got multiple managers running portfolios, multiple holdings, and overall you're going to end up holding hundreds of stocks.
Yeah.
How do you avoid ending up as a quasi tracker?
That's a wonderful question. And we have done and still do an awful lot of work on this subject. I think Roger's absolutely right. The enemy of a fund of funds, or indeed the enemy of the multi-manager structure, is that you can, unless you're careful, end up being an expensive index tracker. How do we avoid that? Well, I mean, it really comes down to, first of all, the bricks that we build the portfolio with. We only employ managers that run high conviction portfolios, that have very concentrated portfolios. So we have 250, 260, 270 stocks within the portfolio. But we're quite happy. We don't try and appoint managers so that we cover the entire investment spectrum. We're happy to have biases within the portfolio, whether it's style biases or geographic biases. We spend a lot of time thinking about how the managers fit together so that there's enough diversification, but not too much that they cancel each other out. And I suppose if you want to employ, there are a couple of measures that are shorthand for whether you look like an index fund or not. One is active share, where if you have an active share of 0, you are the benchmark, you are the index. And if you've got an active share of 100, you own none of the stocks in the benchmark. Our active share is in the high 70s, which is very high for a multi-manager fund of funds type product. Typically, a lot of our managers will have an active share which is in excess of 80 or 90. So their portfolios look very different from the benchmark. And I briefly had a slide up there. I don't know how to put the slides back up again, actually. I won't do that, doesn't matter. But what you will be able to see, I believe that you share the presentations later, do you?
Yeah.
What you'll be able to see is when you look at the top 20 holdings, it looks nothing like the top 20 holdings in any global benchmark I've seen. Yes, we have Alphabet in there, and yes, we have Amazon in there, but we also have a lot of companies that aren't the major constituents of any global benchmark. And we also on our website publish a full list of our holdings. And again, I think you'll see that the portfolio is quite different from the benchmark. And the proof, I guess, is in the performance. And, we want to perform differently from the benchmark, and we keep our fingers crossed that that difference is positive, not negative.
Yes. Well, I'll just, I guess, throw in a slight follow-up to that, which is, how do you stop, or do you mind stopping ending up in a position that's too large in any one particular stock? And what I particularly think is when you're appointing a number of global managers, if they've all got the same favourites, then is that something that you sort of warn them against, that you manage in some way?
I said we gave them pretty free rein when I answered your question earlier. In fact, one of the constraints that we do give them, in fact, about the only constraint that we give them, apart from the ones I've already mentioned, is that none of our managers can own more than 10% of their portfolio in any one company. So if you think about the way that that feeds through into our portfolio, let's say you've got 6 managers or 7 managers that could theoretically own the same company, you're not going to have more than 6 or 7% of your fund in that company. Now, if you bear in mind that Apple, for example, has a weighting of 3% or whatever it is in the benchmark, you know, I wouldn't suggest that a 6% weighting in a company is extreme. In fact, it's very rare that we have a holding in any company that is more than 2% of our portfolio. So again, I would say that actually our concern is normally around the risk of over diversification rather than having too much in any one company. Sometimes some of our global managers do have the same holdings in some companies. Taiwan Semiconductor Manufacturing, for example, is owned, I think, across 4 of our portfolios at the moment.
Everyone owns it.
Yeah, exactly. Alphabet is owned across 3 of our portfolios. Unilever, I think, is owned across 3 of our portfolios, and they sit there within the top 20 holdings. But no, we're very cognizant of that, and it's a balancing act. But it's a balancing act that we focus on a lot.
Very good. Our final question, which I think may have just been prompted by your answer before last, is: do you publish your tracking error versus a global index somewhere? Is that something that people can find out?
Do we publish it? Actually, I'm sure that, you know, any number of these sort of data providers that you can, you know, access would track it. I mean, it's no secret. Our tracking error against our benchmark at the moment is about 3 and a bit, which is, again, I'd suggest is, these are all shorthand terms, of course, and none of them are guarantees of any kind of performance differential or guarantee. But a tracking error of above 3 is high for a multi-manager portfolio. The range of our manager tracking errors is much higher.
Yeah.
And that's, you know, high single digits regularly. So, but when you combine them together, it comes out to just north of 3. We publish in our fact sheet. We publish the active share. Our fact sheet is produced every month, and it's on our website, and it's sent out to people that request it. Maybe I should take that away as a to-do subject. Should we add the tracking error to the fact sheet? I'm always a believer in less is more when it comes to, you know, you try and give people as much information as possible, but you do get to a stage where there's so much information on a page that it becomes illegible. Yes. But no, I think that's, you know, I think every piece of data that we publish, we believe should be useful rather than just additional.
Yeah, no, I understand that entirely. And as someone who spends most of their day looking at data, I'm not sure half of it's useful, but,
yeah.
But there we go. Well, listen, James, I've certainly enjoyed that and found that very informative, and certainly lots of food for thought there, and a good reminder of what Witan has to offer.
Well, it's been an absolute pleasure. Thank you, everyone, for attending. It's a wonderful opportunity for us to talk to you where we wouldn't otherwise be able to. And I'm sure if you've got follow-up questions, somehow you could feed them through to us, and we will be very happy to answer any questions that come our way. There is an email address, contact@witan.co.uk. That's contact@witan.co.uk. If you do want to send in a question, and I or one of my colleagues will answer it directly.